Welcome back, and in our top business story, the private sector in the capital has been forecast to grow 6.4% this year, according to figures released by the Abu Dhabi Chamber of Commerce and Industry. The private sector's contribution to the Emirates' GDP was set at 218 billion dirhams last year, covering nearly a third of Abu Dhabi's total GDP, and is expected to jump to 232 billion in 2012. The figures also reveal that the non-oil government sector is forecast to rise by 5.5% to around 113 billion dirhams this year, up from 126 billion dirhams last year. The oil sector, however, was the main contributor to GDP at 347 billion dirhams in 2011, nearly half of Abu Dhabi's overall GDP of 691 billion dirhams. The overall GDP has been forecast to rise by a record 8.5% to 750 billion dirhams this year, covering 60% of the country's GDP. Approximately 3,000 additional residential units were added to the market in Q1 of this year, bringing the total current residential stock to around 341,000 units, according to a recent report by Jones Lang LaSalle. Almost 90% of the completions in 2011 were apartments. As of the end of Q1 2012, the largest proportion of residential stock added to the market since 2009 is located within the sub-markets of International City, Dubai Marina, Discovery Gardens, JLT and Dubai Land. A total of 28,000 additional units are currently scheduled for completion this year, which would represent an 8% increase on the current stock. According to the report, while liquidity is returning to the residential market and some previously stalled projects are recommencing, it is expected that a substantial proportion of the supply due to enter the market this year will continue to experience further delays.
In practice, we think that this supply is going to take quite a bit longer to reach completion than has been forecast by the developers. And it might be more realistic to view the 28,000 statistic as more of a 2-year supply pipeline than a 1-year supply pipeline. Restarting projects is a complicated process, and it will be a case of one step backwards before 2 steps forwards in some cases, with pieces of work needing undone before it can be redone. The rate of building and the rate at which projects are brought through to completion will also depend on the continuing rate of activity in the marketplace. And if developers see high levels of take-up and increased activity, then they're more likely to accelerate their projects. But if they see large amounts of supply coming in competing schemes to theirs, they might think twice about going ahead speculatively.
Let's now take a look at the stock indices across the GCC. Well, to see what will be driving trading this week, we earlier spoke with Gaurav Kashyap, the head of DGCX at Alpari Middle East.
Well, Laura, the largest stories in trading last week were the 2 stories of the widening bond yields of the European periphery nations, particularly Spanish bond yields, which crossed 6%. Along with that, we had the story coming out of China, the slowing growth and output data. Friday's data showed that Chinese quarterly growth grew at its slowest pace in three years at 8.1%. This is down from the previous reading of 8.9%. Now, although the Chinese data has had its full impact on the markets, we've seen the Australian dollar weaken following that release. We will continue to watch how European bond peripheries and what impact they'll have on the euro currency this week. The Spanish 10-year bond yields have already crossed 6.1% in Monday's trading session, and this has already seen the euro slip weaker across the board. It's hit a 19-month low against the euro, against the pound sterling, and the weakness has seen the euro USD touch about 130 levels, the lowest it's been in about 3 months. So this will continue to have a negative impact on the euro crosses. It's going to be a very big week for the British pound. We have the the Bank of England's meeting minutes released on Wednesday. Now, although we're not expecting to see any change to the 7-2 voting pattern, we can expect to see the pound increasing slightly across the major yielding currencies such as the euro and the US dollar. This is because the pound has been one of the last banks which have been forced to look at additional easing measures. But once again, their comments and their quotes from the Bank of England might have a negative impact in the GBP. Overall, we look at resistance coming at 160 levels in GBP USD with support coming at 156.